Imagine you sell shares worth 10 lakhs today. The trade is confirmed, everything looks perfect. But tomorrow morning, the buyer says just one line: I don't have the money. Now pause for a minute and think. In a market where crores of rupees change hands every second, who takes the responsibility when one side fails? Basically, who protects you? The answer is an institution you never see, but without it, the stock market simply cannot survive, and that is the clearing house. Hello everyone, welcome back to the channel. Today we are going to understand what a clearing house is, why it exists, and how it works behind the scene to keep the financial market safe and trustworthy. By the end of this video, even if you are a beginner, this concept will be crystal clear. So let's move on and start with the definition. A clearing house is a financial institution that acts as an intermediary between buyers and sellers in the financial market and guarantees the completion of every trade. In simple words, a clearing house is a trusted middleman that ensures the buyer receives the shares and seller receives the money, even if one party fails. Now you might think, why is a clearing house needed in the first place? To understand this, let's connect this to the opening story. If the buyer of your 10 lakh shares refuses to pay, you lose money, trust in the market breaks, trading becomes risky. This is called counterparty risk, the risk that the other party will not fulfill their obligation. The clearing house eliminates this risk. Instead of buyer and seller, the system becomes buyer, clearing house, and seller. Now both parties trust the clearing house, not each other. Now let's understand how does a clearing house works. Step 1. Trade execution. Suppose Rahul buys 100 shares of Infosys and Anjali sells 100 shares of Infosys. The trade happens on a stock exchange like NSE and BSE. Step 2. Trade confirmation. The clearing house receives trade details from the exchange, matches buy and sell orders, and confirms the transaction. In step 3, clearing house becomes the counterparty. This is the most important role. The clearing house becomes the buyer to the seller and becomes the seller to the buyer. So even if Rahul or Anjali defaults, the clearing house guarantees the settlement. In step 4, to protect itself and the market, the clearing house collects margin money, monitor daily positions, use mark-to-market calculation. This prevents excess risk taking. Now to protect itself and the entire market, the clearing house follows a strict risk management system. Before allowing any trade, the clearing house checks whether the trader has sufficient fund or margin. So if you talk about delivery trades, if you want to buy shares worth 50,000, you must already have 50,000 in your trading account. If you have only 10,000, the trade will not be allowed because the full amount is paid upfront. There is almost no settlement risk, no MTM is applied after settlement. Now if you talk about margin based trading, in intraday or futures and options trading, you trade using margins, not full money. Since losses can increase due to the price movement, the clearing house calculates losses daily. The losses are adjusted from the margin, that is called mark to market. If margin becomes insufficient, you get a margin call. Position may be squared off to prevent default. Why this system works? By collecting money upfront, monitoring margins, and controlling losses early, the clearing house ensures that no trader can take unlimited risks. Defaults are prevented, every trade settles smoothly. Now in step 5, clearing and settlement happens. Clearing means calculating who owes how much and what needs to be delivered. And in settlement, actual transfer of money and shares happen. This usually happens on a T+1 or T+2 basis. Let us understand it better with help of a real life example. Think of Amazon. You pay Amazon, seller ships the product, and Amazon ensures delivery or refund. Amazon plays a role similar to a clearinghouse. Basically, it builds trust between strangers. Now, let's see some of the major clearing houses in India. NSCCL, that is NSC Clearing Limited. ICCL, Indian Clearing Corporation. MCX Clearing Corporation. They operate under SEBI regulation to protect investors and the market. Now, let's recap key functions of a clearing house, that is trade confirmation, counterparty guarantee, margin collection, risk management, clearing and settlement, default handling. Now, why we consider clearing house as the backbone of the market? Because without clearing houses, market lose trust, defaults increases and trading volume collapses. But with presence of clearing houses, millions of trades settle smoothly every day. Investor trade with confidence. Financial market remains stable. If this video helped you understand the stock market better, like the video, subscribe to the channel and comment your doubts below.